Well, hello everyone, and thank you for joining us today. This is our quarterly market update, and usually we actually do them like in the second month of each quarter. But given the market turbulence, of course, we wanted to update everyone sooner than that, and of course, share our thoughts. And of course, the title is, opportunity within chaos. Next slide, please. Yeah, so to get a couple of admin items out of the way, so this webinar will be recorded, but none of your information will be in the recording. We certainly encourage you to ask your questions in the chat box. Everyone should have access to that. We will address your questions as we go if they're related directly to what we're discussing at the time. If your question requires more of a detailed response, we'll address it as well, but most likely closer to the end of the seminar. The disclaimer is in front of you. We have to, of course, provide it. This is an investment-oriented webinar. Anything that we're about to share with you should not be considered any kind of investment advice. Of course, if you decide to implement, again, any of the strategies that we're about to discuss, we strongly recommend that you do your own due diligence or work with a qualified professional. Slide, please. Yeah, so in terms of roughly half of the people who registered for this event, these are our clients. Of course, welcome. For those of you who perhaps don't know much about myself or our firm, I'll just briefly introduce us. My name is Alex Seleznev. I'm the founder and president of Capital Squared Financial. My partner, Asa De Silva, has been in the wealth management business for over 25 years. And what's particularly interesting about his background, given the circumstances, he actually used to manage a hedge fund that focused on Asian markets. So his perspective of what's been happening specifically between the US and China will likely be very valuable. In terms of our firm, we're a boutique style firm. One of our specialties is retirement and multi-generational planning. A lot of our clients are thinking about transitioning already in retirement, but we work with other clients as well. We're very proactive when it comes to tax planning, which is a little bit on the back burner at this point. And on the investment side, one of the specialties we have is developing what we call fortress financial plans for our clients. And I'll touch on that separately today. At this time, we manage close to 120 million for over 70 families across 9 different states. And we actually have clients in 4 different countries. We always serve as a fiduciary when we work with our clients. And of course, if you're interested in learning more, please visit our website or reach out to us or myself. Next slide, please. So again, for any of you who ever attended our previous investment-oriented webinars, we usually try to come up with a cartoon or a chart or just a phrase that describes where we are in the markets today. So over the past, 2 quarters or so, it was all about the markets hitting a new all-time high. So the question was exactly when it would end. So perhaps we're at that point now. So volatility, uncertainty, market turbulence, and in some sense, those words are somewhat synonymous because again, the more uncertainty you have, the more volatility, and sometimes vice versa. Now, understanding that for many people it can be scary, something that we'll address today, but there are also quite a few, usually professional investment people who love volatility. And in fact, one of them is Peter Lynch. I don't know how many people know him, but he is a very prominent growth-oriented investor. And actually in preparation for this seminar, I was listening to one of his talks in the mid-90s. Sometimes really makes you think how, the more things change in some sense, the more they stay the same. Next slide, please. So to briefly update everyone on the market conditions, something tells me that people are, of course, paying attention given the circumstances. But at the market close yesterday, the S&P 500 index, which is course, one of the most common indices out there, was down by 7% for the year. So this is since the beginning of the year. A much more tech-heavy NASDAQ index was down by 12 percentage points. And again, as a reminder, both of those had exceptional years in 2023 and 2024. Domestic small cap stocks are down by 15%, which is perhaps not surprising. Many of them tend to be more cyclical. Developed international markets, as a category at least, are in the positive. So those types of stocks are certainly providing certain diversification benefits. Emerging markets are essentially flat for the year. There are, again, certain markets that are in the positive, but if you look at them as a category, they're essentially flat. Domestic bonds, at least as measured by the Barclays Aggregate Bond Index, which is kind of like the S&P 500 for bonds, are in a slight positive for the year. Asi will touch on bonds separately. There were a couple of issues that perhaps need to be addressed, but I will say this: if at least a portion of your portfolio is in short-term bonds, you should be fine. We'll also talk about the 10-year Treasury yields. It's a very important conversation because that serves essentially as an input for many other rates, such as mortgage rates. And at least as we speak today, the 10-year Treasury is at 4.3, 4.4% or so. In terms of the sector performance, again, for any of you who attended our previous webinars or following the markets, there shouldn't be essentially no surprises. The more defensive sectors such as consumer staples, utilities, and healthcare, at least as a category, they're essentially flat for the year. Again, that's perhaps expected. More growth-oriented or more cyclical categories such as energy are in the negative for the year. It was essentially in reverse earlier this year. So in terms of, again, the idea of trying to take advantage of where we are in terms of the markets, at least from our perspective, we always focus on protecting what our clients have first. So before we kind of dive into that, these are some of the key ideas or principles that we would like to share with you. So one of the questions, and I got this question several times from our clients, well, how is this crisis different from what we experienced in the past? When we had 9.6% inflation in 2022, or when we had COVID in 2020. Again, Asi will talk about this much more separately, but I'll just say this: this is a self-imposed crisis. And that's essentially what this is. Earlier this year, specifically in January, if you looked at the markets then and the economy overall, there are certainly pockets of uncertainty, let's call it that way. The valuations were certainly high, and perhaps at least some of what we're experiencing now was expected, but it didn't really need to be this way. And to paraphrase the president's analogy when he was talking about performing a surgery and the patient survived, well, think of it this way: we had a flu as a country essentially, but usually when you have a flu you wouldn't perform a surgery. So again, it remains to be seen exactly how this will play out, and we certainly have our thoughts, but that's again one of the differences. One of the core principles is, of course, you buy low, sell high, and I would say most people will likely agree with that. That said, though, and it's a very well-known fact for most people, specifically on the retail side and even on the institutional side, it's very hard to implement this type of strategy. One of the reasons behind that is this so-called recency bias. And if any of you ever studied behavioral finance, which became much more popular in the 70s and 80s, it at least tries to address why usually rational people behave irrationally in times of market turbulence. So again, going back to February of this year, for certain stocks, and you can perhaps make a good educated guess what kind of stocks, the sky was the limit. The projections were just going up, up, and up, earnings growing at 50%, 70%. Now it's the opposite. People are projecting exponentially. We have to be, again, careful when that happens. Uncertainty equals opportunity. Perhaps this is logical in some sense. If there is no uncertainty, and frankly, it's rare when that's the case, when there is like, higher levels of uncertainty, that's when you start looking for opportunities. Because without this particular factor, well, what are the chances that we'll see any? And then finally, I'll tell you this is one of the points I added later on. I wasn't even sure if I should say this or not, but look, in times of crisis like this, and this becomes a bit of a political crisis as well, many people are watching news, of course, and perhaps you're spending, a couple of hours a day watching news and, certain media outlets, and they portray a certain picture, right? Now, in practice, at least when it comes to finance or investing, things are never, or at least rarely, as bad or as good as they appear to be. And that applies to, again, where we are now, on April 16th, or perhaps where we were on February 19th, which is when the markets were at the highest point they've ever been. So next slide, please. So how do we, again, protect what we have and, perhaps take advantage of the markets? Well, the answer to that question depends on your investor profile. There are, of course, dozens of them out there, and it's entirely possible that you would be, your situation would be a combination of the two that I'm about to discuss. But again, these are the investor profiles to consider. Next slide, please. So here's one option, and I certainly hope this is not going to offend anyone, but I do want to address this. Let's just assume that you have no plan in place. And by the way, I'm not talking about financial planning here. This is beyond the point. Let's say you've been diligently saving over the past number of years. You have a 401k, you have, a number of different accounts, and you just kind of throw in money at it and it just keeps growing, which, used to be the case in 2023 and 2024. But realistically, if you kind of sit down and look at it, you realize that there's no plan in place. When that happens, usually one of the biggest issues is panic selling. People look at their statements, again, things continue to go up and up, up and up. Then all of a sudden there's a drop, they start selling. In most cases, that's a big mistake. So please be careful if you find yourself in that situation. The opposite is, also concerning. There's this notion that, anytime there's a market drop, you just buy the dip, because the markets will always go up. So all you have to do is pretty much buy it. Now, perhaps there's some truth behind that, and we'll cover that separately. If you have, many years ahead of you before you decide to draw from your accounts, perhaps that's okay. But keep this in mind, market recoveries are rarely linear. That's very important, and we'll have a slide on that separately, meaning that it's possible that there's going to be a rally, and then again, the markets decline again. And if you have no plan in place, there's a possibility that, again, you're going to start selling, which kind of makes this issue even worse. So if you find yourself in this situation, the best suggestion I can make, don't sell anything yet. You don't necessarily have to buy anything. Come up with a plan, which can be put together rather quickly, and only then take some kind of action. Next slide, please. So let's say you're a long-term investor, or to say this differently, you have a long investment horizon. And from our perspective, just to quantify this, let's say you're not planning on taking any funds out of your accounts for 5 to 7 years. Well, one of the suggestions, of course, is to continue to gradually invest. Let's say you have a 401k or 403b account. Consider increasing your contributions if you can, of course, afford to do so. So let's say you're contributing 10%. Perhaps it would make sense to bump it up to something like 11 or perhaps even 12%. So that's a consideration. For actually many of our clients who are business owners or self-employed, they usually make their contributions at the end of the year. Now, perhaps one of the considerations is to do that earlier in the year. And to make it very clear, I'm certainly not suggesting that you just go all in, right? Because again, the market recovery may take some time. But if you have that option, well, consider again pre-funding your investment accounts. And that, by the way, applies across the board, IRA accounts, 529 plans, if you have a UTMA account, so all of that. If you're comfortable, if you have a plan in place, perhaps you would even consider tilting your portfolio toward more growth-oriented stocks. I have to be very careful when I say that because very frequently growth almost like equals technology stocks for some people. That is not the case. That is simply not the case. There are a lot of high quality growth stocks outside of the Magnificent Seven and actually outside of the US, something that we'll be discussing separately today. Next slide, please. So let's say you're 1 or 2 years away from retirement, as an example. You're retiring soon, or you're already in retirement. Well, at least for our clients who are in this situation, we would have a what I call a fortress financial plan in place. Again, we're not going to go over that in detail, but very briefly, what does that entail? That means that you have usually close to a year of your cash needs in reserves. You have 5 to 7 years in short-term, usually treasury bonds available to you. Usually 70% or so, it can be more, can be less, of your projected expenses are covered by your portfolio income. Over the past 2 years, 2023 and 2024, I will say this, we had plenty of options to rebalance. So we already kind of moved things more into more of a conservative allocation to begin with. And of course, there is a growth portion as well, because if someone has 10, 20, or maybe 30 years ahead of them, there needs to be some growth. If you're in that type of situation and you're comfortable on your plan, this is the time to rely on your plan. Because again, that's why you've been doing this. Like I like to say, I've been working with many of my clients for over a decade at this point. And we talk about this and you never know what's going to happen next, but that's why you have that plan in place so you can rely on it. Now, let's say you need some cash for your cash needs, whatever that is. Let's say for tax payments as an example, it's perfectly fine to use some of your bonds because again, that's why you have them to begin with. In 2023 and 2024, we're actually mostly using stocks for that purpose. Let's say somehow, some way, you're not overly confident about what's been happening and you want to make some adjustments to your portfolio. Again, be careful, but if you want to put some in gold as an example, or TIPS or treasury inflation protected securities, that's also fine, but I would be careful about that. I wouldn't go all in and put half of your portfolio in those types of things. But inflation is certainly a concern, and if again you want to address that more, that's one of the options. If you want to take advantage of the markets, and let's say you're not comfortable with more growth-oriented stocks, that's fine too. You can make limited purchases. You can focus on dividend-paying stocks, and I'll tell you we're big fans of dividend-paying stocks at Capital Squared for the reasons I mentioned earlier. There are a lot of them. They're actually down this year. Certainly not as much as some of the big tech names. So that can possibly be a safer way for you to take advantage of the markets. Next slide, please. So this is a simplified, and I want to emphasize, this is a simplified example of how we would approach this for some of our clients who, again, have a fortress financial plan in place. This is, by the way, very similar to how we implemented it in 2020 during the unprecedented uncertainty at the time that was caused by COVID. So one of the advantages of this approach, it gives us the option to take calculated risks. So we're not gambling here. So here's how it works. Let's say someone has a portfolio of $1 million. We've been diligently adjusting it over the past number of years, let's say 2 years, and now we have 60% in stocks and 40% bonds. In simple example, we know that this particular client needs $350,000 to cover their cash needs over the next 7 years. So we need to keep that in place. 7 years, by the way, is this average business cycle in the United States. Now, if we have 400,000 in bonds and 350 is needed, now we know that 50,000 in this example can be safely invested depending on each particular client's preferences. Growth stocks, dividend-paying stocks, some other types of investments. It really depends on a combination of them. But what's important here, If the markets recover over a longer time period, we don't really know how long it's going to take for them to recover, the approach here would have a very limited impact on someone's lifestyle. So again, this is a way to take those calculated risks.